couple of interesting things are starting to pop up on kind of overall report and directional guidance on data that's coming in, both from 2022 and kind of the first 31 days of 2023. But just high level, one thing that's kind of important to think of and how we look at our total addressable market. The census data just came out for 2022, and it shows that individuals continue to own the largest share of single-family rental homes. So, it's what we already kind of knew and talked about, but it just came out again that individual owners account for 72.5% of all single-family rental homes in the United States, the largest share of any ownership group. The next largest share of single-family rentals are held by, basically our LLCs, our LPs, and all those different types of ownership structures that are employed by individuals and small businesses, which make up about another 14.3%. 85% plus of single-family rentals are there to attack for refi and new purchases, and that's kind of what we've seen and we'll continue to see and grow going forward. Some other work we're looking at, some interesting stats kind of popped up that kind of gives you an idea of the ownership of 2+ unit properties. So multifamily unit properties from 2 to 99 units, break it down actually in more particular unit. 2 to 4 unit properties make up 82% of the multifamily housing stock. So that's 2.3 million plus properties. Property sizes from 5 to 24 units make up 13%, or 375,000 properties. And then property sizes from 25 to 49 units make up 3%. So right there, 94% plus are between 2 to 49 units. And that's kind of the direction of the guidance of what we're trying to achieve with building a process towards this, both a bridge loan and a permanent loan execution for the 5+ unit properties. Interestingly, in this report from the National Multifamily Housing Council, individual investors own 22% of all 5 to 49 unit properties. While individual investors plus LLCs, LPs, kind of those ownership structures and partnerships, they own 75% of all properties between 5 to 49 units. So again, pretty large target market of what we're dealing with, and not necessarily so institutional as you'd think, just in looking at multifamily. Moving back to the housing market, Adam showed that on average, home sellers realized a profit of $112K on the typical sale in 2022. It's up 21% from $92,000 in 2021. Basically, the report's showing that obviously a diminishing inventory in the first half of the year pushed prices up, and kind of less and less inventory, still kind of keeping prices up and propping them up, as opposed to a flood of inventory hitting the market. Again, kind of the areas that saw the largest price increases in 2022 were Tampa, Raleigh, Austin, Orlando, and Tucson. And home prices reached new peak highs of all time in 153 of the 157 metros analyzed. So 97% of the MSAs analyzed in the country, including all the major markets. So, we hit peak pricing. Obviously, that's part of what's driving some of the more conservative leverage, and on that back and forth yesterday, and people are talking about with upfront, there's people showing really high loan to cost, but really what's governing that will be the loan to after repair value. And so you see a lot of pullback there from 75 or 70 down to 65 or 60. So pretty interesting in terms of just the overall health of the housing market. Redfin has an interesting report which shows obviously some signs of life and towards a recovery. I think the big first one was that last week's report from the National Association of Realtors showed that pending home sales increased in December for the first time since May 2022. That's the first time after 6 months of declines. Month over month, contract signings fell in the Northeast and the Midwest, the cold states, but climbed in the South and the West, the warm states. Basically, they're saying that in terms of their data points they're seeing and listings and touch points there, that home buyers are coming off the sidelines so far this year, really focusing on bidding wars and trying to find the prices trying to find homes that are suburban, single family, move-in ready, and priced competitively. Makes sense. The report also noted that condos and really higher priced luxury homes are still struggling to sell, and they're seeing a real big uptick in buyers or potential buyers requesting first tours. So interesting to see that capturing of big data and that there is kind of some movement now that, the 30-year fixed rate mortgage for a consumer home loan is starting to pull back a little bit. There's a couple of good factors in there, and one person noticed that in San Jose, they've seen done more showings in January than they did the entire third and fourth quarter. Listings that were stagnant in November and December are steadily getting 1 to 2 offers. So the biggest factor they cited that's most likely to slow or reverse the housing market recovery is that there are too few homes for sale, which is lack of inventory, which could hold back total sales volume and price people out of home buying. So again, this all plays into what we have to offer. It's a very differentiating factor, and not only our lending platform, but our property portal and increasing inventory there from more and more sellers that are coming on. I thought the last piece definitely caught kind of the headlines out there, but Goldman Sachs published their own report, and they cited 4 cities that are likely to see a 2008 style housing crash, cities being San Jose, Austin, Phoenix, and San Diego, with potential for peak to trough declines of over 25% and localized risk of higher delinquencies for mortgages. The other part of the report, they think that interest rates will remain higher for longer than expected, and they notified kind of their clients that is their forecast for the 30-year fixed mortgage rates end the year this year at 6.5%. That being said, even though there's that drastic decline they saw very almost stagnant or slightly declining home prices in New York, Chicago, and saw prices increasing in Baltimore and Miami. So overall, a lot of that's a look back on data that's coming in. It seems like more and more activity is picking up on home buyers out there, which is for classic fix and flip, an improvement in terms of hopefully deal flow.